Hello, Finance 322. Sorry about all the confusion with the Zoom meeting and the exam. However, I hope that you guys are very successful on that exam. So again, it's 26 multiple choice questions where the 26th question is extra credit. All right. Well, today what we need to cover is we need to cover Chapter 16, Short-Term Financial Planning. And so, of course, whenever we talk about short-term, we're talking about current assets and current liabilities. And so let me go ahead and share with you the PowerPoint for Chapter 16. And I'm also going to take down my video so that I can draw on this. And you're not just staring at the my ceiling. And so short-term planning and financial planning, or short-term financial planning, whenever we're talking about short-term, we're talking about something that is 365 days or less. And so in this chapter, some of the concepts and skills that we need to understand: the operating cycle and cash cycle, and understand why they are important; the different types of short-term financial policy, and the essentials of short-term financial planning. All right, and so starting off, and again, unfortunately for you non-accounting majors, we are going back to talking about the accounting equation and components thereof. All right, and so when we look at the accounting equation, again, what we're doing here, let me get some things to draw. Okay, we have our assets equal liabilities plus owner's equity. Okay, and so basically what we're doing here is we're saying, hey, we're going to take out the long-term assets, right, and then we're going to look at short-term. And I guess in reality, what we've done is we've taking the short-term assets, subtract our liabilities, right? Because if you remember, one of the financial equations that we learned in Accounting 201 and or 202, because we did the complete review, right, is working capital. You remember the working capital? Right? All working capital is, right, our current assets subtract current liabilities, right? And with that same information, or when we talked about that, we also talked about the current ratio, and normally then we slid into the quick ratio or the acid test ratio, all right? And so, they're breaking apart, the net working capital here, and we're basically saying, hey, our current assets subtract our current liabilities. And why they're identifying this cash is because what we're going to be talking a lot about this chapter is the management of cash. All right. And so what they in essence do is they take the accounting equation and they just isolate the cash, and they say, hey, cash is equal to long-term debt plus equity plus current liabilities. All right, we took it to the other side. And from that, we're going to subtract the current assets other than cash and our fixed assets, isolating just cash. Right? Because I can't remember if it was this, I think it was last chapter when we talked about cash is king, all right? What was that? Yeah, I can't remember. All my chapters are starting to, no, that was my intermediate class where we were talking about cash is king, all right? And especially in these days of financial turmoil, organizations or businesses need to carry sufficient cash on hand in order to be able to make it through this pandemic, right? And so the sources and uses of cash, right? So hopefully you can draw on your remembrance of the cash flow statement, right? But sources of cash are really cash inflows, right? So inflow. Okay. So we can get cash by selling bonds, right? That's increasing long-term debt. We can get cash from selling stock, right? We can increase, current liabilities, right? Liabilities. So, we could borrow in the short term. We could decrease a current asset. So if we have accounts receivable, all right, goes down. Okay. Well, how does accounts receivable go down? Well, somebody's paying us, aren't they? They're paying us what they owe us. And then a decrease in fixed assets. We can sell a piece of equipment and so on. And so the uses of cash, all right, or the outflow, okay, pretty much, just the opposites, right? We could buy, all right, back our bonds, or we could pay those bonds off, all right? We could purchase treasury stock, right, decreasing equity. We could decrease the current liabilities, all right? And so, we're paying back our liabilities or increase current assets. We could take that cash and buy inventory, right? Or we could take that cash and we could buy buildings, equipment, and land. So hopefully that's pretty straightforward. So what we're going to be looking at is we're going to be looking at an operating cycle. And so kind of interesting for those accounting majors out there, you actually know that the term current is a little bit, when we talk about it in accounting 201, 202, it's a little naive, isn't it? So when we say something is current, as long as it's within 365 days, that is deemed to be current. However, if you actually are an accounting major, in intermediate, we expand that definition of something that is current, right, to be 365 days or the operating cycle, whichever is longer, right? And so when you think about the operating cycle, you want to be thinking of a circular method, right? And really, it's how long does it take to have cash, right? And when you're going to take that cash and we're going to purchase inventory, okay? And then we're going to sell that inventory and we're going to sell it on account, okay? And then we're going to collect the cash, all right? And so this process, okay, and if you were in my class through principles, I refer to this a lot as the snowball, all right? And so, the snowball, it's the operating cycle. How many times can you turn over, right, going from cash, right, going through the, so I use the example. So we had $20,000 in cash, right? With that $20,000 of cash, we purchased $20,000 of inventory, okay? We sell that at 100% markup, right, for $40,000 on account, right? And then we collect that $40,000. And so as long as we don't take away from that, we can take that $40,000 and put it into our operating cycle. And yes, this is a basic method, all right? So if we took that 40 and put it through our operating cycle, we could turn that into 80. 80 into 160, 160 into 320, and so on and so on and so on, right? That's the operating cycle. That's how we as a business are able to grow, right? So for finance, okay, we're going to break that operating cycle into two components. There's the inventory period, okay? So once we've taken that cash and we've bought inventory, how long does that inventory sit on our shelves? Okay. Then, right, we're going to add to it also the accounts receivable period. So once we sell that, how long does this remain uncollected? So the inventory period is the number, or it equals the time inventory sits on the shelf, and the accounts receivable period, how long does it take to be able to collect accounts receivable? And so hopefully this is starting to trigger some, remembrance, all right, to when we calculated the number of times, all right, not interest is earned, but the number of times sales and receivable, okay, or even going further back to the inventory and accounts receivable turnover ratios, because that's really what we're going to look at, all right? And so the operating cycle carried from the last page or PowerPoint equals the inventory period plus the accounts receivable period. And so the inventory period, okay, takes 365 days, all right, and divides that by the inventory turnover. So if you remember, okay, in Accounting 201, they gave you kind of a long drawn out equation, they took the average net income, or I should say the average, uh, yeah, cost of goods sold, and we divided it by the average accounts receivable, or I should say inventory. Okay, and they gave you a long, drawn out. Well, I gave you guys the quick and easy one, right? So we refer to it in Accounting 202 or 201 as the number of days in inventory. Okay, and down here we had the number of days in sales of accounts receivable, something to that effect. All right, but basically what we're doing is we're saying, hey, we have to find out how long does our inventory sit on the shelf. Okay, that's going to be the inventory period. How long does it take to collect the accounts receivable? To get this information, we're going to basically have to start with, right, the inventory turnover ratio and the accounts receivable turnover ratio. And at this point, I always say, hey, do you remember the relationship? So, whenever we made a sale, okay, we said, hey, we made a sale on account. That was accounts receivable, sales, okay, right? And then we also, because of perpetual inventory, also recorded the cost of goods sold and inventory. Okay, and so these two items, they go together, right, for the accounts receivable turnover ratio. These two go together for the inventory turnover ratio. And then obviously with the accounts receivable turnover ratio, average accounts receivable is the denominator, okay? Whereas on the inventory turnover ratio, average inventory, okay, is the denominator. Okay. With this little calculation down here, okay, hopefully you can identify what the numerator is. So for the inventory, okay, these things go together, right? Cost of goods sold is the numerator. Okay. Here, sales, right, is the numerator. Yeah, hopefully just some little tips for remembering. Okay. And so the time between the payment for inventory and the receipt from the sale of inventory, right, is referred to as the cash cycle. Right? The cash cycle is made up of the operating cycle, which we just got done doing, subtract the accounts payable period. All right, and so the accounts payable period is just how long, right, does our accounts payable stay unpaid, right? The time between the receipt of inventory and the payment of the inventory, or the payment of accounts payable. So the cash cycle, all right, measures how long we need to finance inventory and receivables, right? Because really what we're trying to figure out is how much cash are we going to have on hand, or should we carry on hand? So the cash cycle equations, all right, as we said, the operating cycle, we did that on the previous slides, okay? But really it's the accounts payable period, right? So the accounts payable period is, again, the 365 days, right, divided by the accounts payable turnover. Well, what is the accounts payable turnover? Well, it's cost of goods sold, right, which is the numerator, divided by, again, the average accounts payable. And again, to get an average, take the beginning and the ending, add them together, and divide by 2. And so what we're able to see here, all right, is we're able to see the, excuse me, the operating and the cash cycles laid on top of each other, all right? And so the operating cycle, okay, again, had the two parts, the inventory period and the accounts receivable period, okay? Whereas the operating cycle, okay, consisted of the cash cycle and the accounts payable cycle. Okay. And so when it comes to corporate management and short-term financing, all right, there's different positions, all right, that do relatively this kind of calculations. If you remember before, I basically said, hey, when we had our corporate ladder and we had our CEO, oops, we had our CEO, okay, and under him, you had all the VPs, and over here we had the CFO, okay, and then under him, okay, he had all these different. Well, actually, we only did two. We did the controller. What I've done in the past, all right. We've done the controller and the treasurer. I know you can't really see that, all right, but hopefully that jogs your memory, all right. Really, it's generally the treasurer side, okay, that deals with the short-term financing plan. It's the treasury department, all right, that does all the cash deposits, from the daily sales, all right. They're the ones that are, identifying, where they're going to borrow money. Are they going to sell bonds? Are they going to sell stock? Things along that line. But basically what they're doing in this table is showing you just the different titles, okay, of the manager who would be managing these cash. And so we have an example, all right. Again, this is going to be a question on the exam. Know that for a fact, all right, which is basically understanding how these different cycles interact, right? And so we have beginning, ending of inventory, beginning, ending of accounts receivable, beginning and ending of accounts payable, all right? They already did the averages for us, right? And so, we have, these numbers over here, okay, and we're going to just identify which numerators to give us the turnover ratios. And so they show us down here, they have operating cycle again, is broken into the inventory period plus the accounts receivable period. And so to find out the inventory period, we're going to first of all need to figure out the inventory turnover. Okay. And we're also going to have to do that same thing for the accounts receivable as it gets down to here. Right. Then finally, all right, the cash cycle, okay, consists of the operating cycle, same thing up here, subtract, right, the accounts payable period. And so that's what that slide, earlier was trying to identify for us. Okay. Really the breakdown of all that. Okay. And so the inventory period, okay, the first step that you need to do, okay, is you need to figure out, all right, the average inventory. Like I said, they already gave us that information, all right. They gave us the, $2,500,000. Okay. Apparently they dropped some zeros there. Okay. So yeah, I think that they dropped some zeros. Inventory, okay. So accounts, let's see. Yeah, they did. My bad. Okay. So, I mean, utilizing these numbers here, all right, it was 2,500,000, okay, and 8,200,000. However, it doesn't really change, okay. If we drop the zeros, it just, less numbers we have to calculate, all right. But basically, what we're trying to identify, all right, is this, the inventory period. And so we first of all had to figure out what our inventory turnover rate was. Okay. And then we brought that, okay, and divided it into 365. Okay. And just FYI, okay, if you're doing this and you come up with 0.0291, something like that, okay, I hope that you realize that you have done it wrong. Because really what we're trying to identify here, all right, are days, okay? And 0.02 is not a day, all right? They're going to be whole numbers. I mean, they can be fractions of a whole number, but, like 5.02394, something to that effect, all right? But it's got to be a whole number. There's got to be, at least a 1 there. Okay, so if you get a small decimal point, you've done something wrong. And typically what people do wrong, I just made up that number, by the way. They take 328 and divide it by 365. I don't know what that even comes out to be, but it's going to be a small fraction. 3.28 divided by 365. Yeah, that comes out to be 0.008983, something like that. All right. Obviously, that is wrong. Okay, and what you basically did is you flipped it. All right. I have students do this, and I think it's Accounting 202. All right. And if they get this wrong, all right, it's because they flipped that. So we did the inventory, we do the accounts receivable, and so we can say that our operating cycle to go from cash, right, to cash is 168 days. Okay. Then, all right, we identify the accounts payable turnover. Okay, and so we're going to take the cost of goods sold, right, divided by the average accounts payable. So beginning and ending, add them together and divide by 2. And then, all right, so we come up with this number, 9.4 days. And then we divide that, or not days, that's times. Right? And so what this basically says is that we turn over our accounts payable 9.4 times. Right? So that means that, we enter into an accounts payable, pay it off. Enter into accounts payable, pay it off. Same thing with inventory. All right, when the inventory turnover, it's just we buy inventory, we sell it. We buy inventory, we sell it. Right, and the same thing with accounts receivable. We make a sale on account, we collect it. We make a sale on account, we collect it. All right, and so taking this number, we plug it into the accounts payable turnover period. Okay, 365 divided by the 9.4. We come up with 39 days. And so we take the operating cycle and we subtract the accounts payable turnover, or accounts payable period, I should say. And so our cash cycle is this 128 days. And so basically what it says is inventory and receivables must be financed. Okay, you need to borrow cash, right, for 129 days total. So then that brings us into our short-term financial policy. There's 2 types, and then there's hybrids. All right, so the 2 extremes are a flexible policy, and then the opposite is a restrictive policy. With a flexible policy, basically what we're doing is we're keeping large amounts of cash, right, on hand. Oops, I wanted to do that in the highlighter. Okay, don't know why. Large amounts of cash and marketable securities on hand. All right, this means that we're flexible. It means that, hey, if we need to respond quickly, we have the cash on hand. All right. So it also identifies, it's a flexible policy, also has large amounts of inventory. Okay, we give liberal credit policies. So hey, this guy, all right, doesn't have great credit history. We'll lend him money anyway. Okay, that's a liberal credit policy. All right, and relatively low levels of short-term liabilities. Okay. This is highly liquid. Right? Having a flexible policy. A restrictive is obviously just the opposite. All right, we have low cash and marketable securities, low inventory levels, okay, little or no credit sales. All right, everything's COD. All right, because we're being very restrictive and lending money to people. Okay. Relatively high levels of short-term liabilities, okay, and very low liquidity. And again, liquidity is how quickly can you turn things into cash. So the advantages, all right, and disadvantages of a flexible, all right, the advantage is no difficulty in meeting short-term obligations. You can pay what you owe, right, because you have the cash on hand. Cash is available for emergencies, right? And we have lower storage Disadvantages, however, okay, liquid securities equals a lower return, right? And so if you think about your assets of a business, right, cash, the only thing that's going to earn you, okay, is interest, right? So when we have a bunch of cash on hand, okay, we're not putting it into our system, right, through our operating cycle, and therefore not getting the weighted average cost of capital that we just got done calculating, right? We're just getting the interest rate. And so, right, we're financing short-term assets with long-term debt, right, which can be very risky. Where we have restrictive financial policy, okay, the advantages, high return on long-term assets, okay, so again, the opposite, lower carrying costs, and then short-term liabilities can be decreased more easily in case of an economic downturn. Disadvantages, less liquidity for emergencies, and higher storage costs. So, carrying versus shortage costs. All right. So in the previous example, we, strengths and weaknesses, we identified carrying costs. Well, what is a carrying cost? Well, it's the opportunity cost of owning current assets, right, versus long-term assets that pay higher returns. Because if you remember, when we have our weighted average cost of capital, right, we're saying, hey, we're financing, okay, using, equity, common stock, preferred stock, and debt. Okay? But what are we doing with that money? Are we buying fixed assets, equipment, buildings, things that hopefully have a better return, okay? Or are we just putting it into checking account, right? And so the cost of storing larger amounts of inventory. Shortage costs, right, are basically two things. There's the order cost, because if you don't have as much on hand, you have to make more frequent orders, and there's a cost to that. It's the cost of ordering additional inventory or transferring cash. Whereas stock out costs, okay, the cost of lost sales due to lack of inventory, right, and it includes lost customers. All right, and so probably most of you guys have, if you're an accounting major, have had Finance 320. I'm sorry, Math 129. This is Finance 329 or 322. But Math 129 basically takes statistical methodology and applies it to business transactions. And one of the things that you guys talk about there is this, economic reorder point, okay, and then also the inventory reorder point, all right, which is, at what point do we actually buy more inventory, right? And so those are the things that we're taking into account, hopefully to minimize, right, the stock out costs, right? Because we want to make sure that we have product to meet the needs, right, of our customers. And so we want to look at the difference between temporary and permanent assets. A permanent assets, okay, the level of current assets the company retains regardless of any seasonal sales. So we always have a compensating balance of $300,000, right? We always have to have $300,000. Okay? Whereas a temporary current asset is the additional current assets added, all right, when sales are expected to increase on a seasonal basis. All right, and so this is kind of, we're gearing up for Black Friday, right? And so we need to have more cash on hand so we can buy more inventory so we can meet the increase in the demand. And so here are two pictures, okay, that really I think are advantageous. All right, and so we had our flexible, okay, and basically what that means is that we have we're carrying a lot of liquid assets, right? And so the pink represents cash. Okay, so let me see, this is cash. Okay, and so when we have the cycle of cash, it's going up and down. All right, if we have excess cash, when we have a use of cash, all right, we can supplement that with the marketable securities. All right, so hopefully you see these are marketable securities. Okay. Whereas in here, okay, you know, again, the pink is the cash. Okay, that's the permanent cash that we hold. All right, these waves, all right, deal with the market or you know, the flow of demand for our product. All right, and so here, when we had excess, all right, cash, we invested in marketable securities. Okay. Over here, okay, when we need more cash, okay, when we need more cash, so this corresponds, right? So this is 1, okay, and this is 1. This is hump 2 and hump 2. And so, you know, the two different methodologies, let's have a lot of cash on hand, right? And this one, not as much cash on hand, but when we have a higher demand, we go out and we borrow. We short-term finance this thing, right? Short-term financing versus, you know, putting our money in a marketable security so that we can access it quickly, all right, if we so need it, okay? And so really it's just trying to differentiate between the flexible and restrictive cash policy. So which one's better, okay? You know, in trying to identify, should you have a flexible cash policy or a restrictive one, okay? Things that you need to consider, right? The cash reserves that you have on hand, maturity hedging, okay? Relative interest rates. And so really in most cases, there is a compromise. All right, you borrow short-term, all right, cash to meet peak needs and maintain a cash reserve for emergencies. And so, you know, this is, you know, the flexible, compromise, and restrictive policies. All right, we're basically saying, hey, how much, you know, in this case, okay, the compromise, it's obviously between the flexible and the restrictive. And that can adjust, all right, up or down depending on the type of industry that you are in and utilize. So that brings us to the cash budget. Right? It's the primary tool in short-run financial planning. Okay, and what we need to do is we need to identify the short-term needs and opportunities, okay, and identify the short-term financing that may be required. How it works: identify sales and cash collections, identify various cash outflows, subtract outflows from inflows, and determine investing and financing needs. All right. And so we briefly talk about this in Accounting 202, all right, when we talk about budgets, and we also talk about it in Managerial Cost Accounting, Accounting 214, if you took it. All right. But basically, what we're doing is we're seeing, based on some sort of industry average or historical pattern, okay, how money flows in and out of our business. Excuse me. All right. And so an example down here, all right, is we identify our sales. Okay. Well, how many ways can we make a sale? Right. We can make a sale on account. Oops. Okay. We can make a sale on account, or we can make a sale for cash. Okay. When it comes to the cash budget, we're going to basically say, hey, you know, every time we make a sale, all right, we're probably going to make 95% of our sales, okay, as accounts receivable. That means that 5% of it is going to be, you know, a cash sale, all right? And so when we come up with our cash budgets, all right, you know, this is obviously an inflow this month of cash. Okay. With this 95%, okay, we might collect this, all right, maybe we collect 10%, right, this month, okay? And so that's obviously going to increase the cash that we collect this month, right? And then maybe it's like 75%, right, next month. Okay. And then that means we have 15%, okay, the third. Okay. Now, where do we come up with these? Okay. Where do we come up with those? Those are estimates, right? Those are estimates that we've made in the past. Okay. Maybe it was a historical average, all right? Maybe it was an industry average, who knows? Okay. But what we're basically saying, if we're trying to find out what the cash inflows for a particular month, all right, we're first of all going to look at sales, all right? And so let's just say that this is March, okay? And so March, okay, we made a sale in March. 5% of March's sales are received in cash, so we include that, all right? Then, all right, the 95% of sales, all right, in March, okay, we're going to collect 10% of those in cash in March. We're going to collect 75%, right, in April, right, and then 15% in May. But, okay, if you think about March, we are also collecting 75% of February's sales, okay, in March, and we're collecting 15% of January's sales in March. All right, because we're just using, all right, these assumptions is the word I was looking for. Assumptions that we have made. Okay? And so when it comes to outflows, okay, when we buy something, all right, how many ways can you buy it? Well, you can buy it on account or you can buy it in cash. And so let's say that 99% of everything we buy it on account, okay, which means we only pay 1% in the current month, right, for those purchases. Do you get where we're going? Because basically what this chapter does is it has you put together a cash budget. Right? Well, I want you to know on the exam, you'll need to be able to apply like these percentages and stuff to identify, cash flows, but you're not going to have to put together a complete cash budget. Right? Understanding the methodology is really what I'm after as far as testing on the last exam. And so here we have a cash budget for fun toys, all right? And, they gave us some information. They have first quarter, second quarter, third quarter, fourth quarter, all right? We had beginning accounts receivable. Here's our collections, all right? So beginning receivables plus half, all right, times sales, okay? For instance, in the first quarter, okay, we're going to collect, all right, that 120, all right? We're going to collect that beginning receivables of 120, okay, and we're going to take half of the sales of the current period, or 200, okay, and so this comes out to be 100. All right. Okay. So that means we're going to have 220 that is collected in the first quarter. Accounts payable is 60% of sales. All right. And so sales this period is 200. So we're going to just multiply that times 60%. Okay. And that's the amount of accounts payable. Okay. And then, it goes into, basically 20%. So all you really need to do, all right, in the real world, see, because you're not going to be coming up with these percentages, all right? Your boss or the CFO or the treasurer, he's, been here the longest, all right? And they're going to give you this information, all right? You might have to assemble this, but thankfully we have an Excel spreadsheet, okay? All we have to do is take the numbers that we are estimating, okay? And we're taking those right off our budget, okay, our sales budget, because remember, when we're doing our budget, sales, right, is the starting point of all budgets. You start with sales. Sales drives production. Production drives direct materials purchasing, direct labor, and factory overhead. Right? We do all that to come up with our budgeted cost of goods sold, right, and so on and so on and so on. And so all we're doing is dropping these numbers in, okay? And so you can see that, hey, we had, the cash collections, right? We had the 220, okay? That was 50% of, the current quarter sales. So that's 100 plus the beginning. One period's ending is the next period's beginning, right? And so they just, again, using an Excel spreadsheet, you can see that down here if you want. Okay. And they come up with all the cash inflows. All right. Then they do the same thing with all cash disbursements. They say, hey, here's accounts payable. All right. And so we just took sales, all right, of 200 times 60%. Right? And that's how we came up with that in the first period. Okay. We did, I think this was a percentage also, wasn't it? Okay. And so we just expend this. This capital expenditures right here, that actually comes from our capital expenditures budget, all right, which, is part of the, what is it called? The operating, not the operating, the operating budget, I think is what it's called. All right, so the operating budget consists of the income statement budget along with cash and capital expenditures budget. But basically, we're trying to figure out, here's our, excuse me, our cash disbursements for the first quarter, all right? We have our cash collections for the first quarter, and we're looking to, buy some equipment in the second quarter for $100 million, all right, or whatever. And so what we're able to do, right, is we're able to project this out, all right? So we had our, cash inflows or cash outflows. So we have a net cash inflow for the first quarter of 40, all right? We add that to our beginning balance in cash, gives us our ending balance in cash, right? However, all right, this minimum cash balance right here, okay, that can either be self-imposed or that can be based on some sort of loan covenant. If we've borrowed money, a lot of times banks will say, hey, we want to make sure that you have $10 million on hand at all times. Right? It's just a safety factor. All right? And so what happens, all right, is that you see that, in the second quarter, we actually run a deficit. Right? We're $60,000 under what we need. Okay? This, all right, is where our treasurer steps in and they say, hey, in order so that we don't break any loan covenants, we need to go out there somewhere and borrow some money. Or, okay, that's long-term financing, right? Or we can sell some stock, because we need it for at least, all right, the rest of the year, all right? Because, if you look, we actually get, into a positive number, okay, in the third quarter. Okay? But then we end up again in the hole, okay, where we have a deficit here. Right? And so, the deficit really, the real cash is we're only under 10,000, but because of our loan covenant, we need another 10,000 in our checking account, okay? And so we're going to have to do some long-term financing. And so where are we going to get that money? All right. Well, some places, all right, we have a prearranged line of credit, okay? It's agreement with the bank that allows a firm to borrow up to a certain amount of cash in the short term. It may require a cleanup period, or basically, hey, you need to pay this off within 60 days or something like that. Okay? Whereas another short-term borrowing is a committed borrowing, okay, where it's a formal legal agreement, all right, that requires a commitment fee and generally has a floating interest rate. Right? And so, this would be a short-term note. Right, where you just, you actually fill out the note, you're going to pay interest on this, and, it's generally a floating rate. Non-committal, okay, informal agreement with a bank that is similar to a credit card, debt for an individual, okay, and then revolving credit, non-committal agreement with a longer time between evaluations. So again, how are these be asked in multiple choice questions? Hey, tell me what a line of credit is. Short-term borrowing, right, with secured loans. A secured loan is backed by something, right? And so the first one is assigning receivables, right? And so assigning receivables is basically earmarking, all right? So we have, $300,000 in accounts receivable, all right? When we collect, we're going to borrow money, all right? And when we collect these receivables, we use the money that we collected from those receivables to pay off the loan, right? Whereas factoring is actually a sale, all right? we're going to sell our accounts receivable to some sort of third party. Now, for those that are in intermediate, we cover this a little bit more in depth, all right? Talking about factoring and assigning. Okay, assigning is we're just using it as collateral. We're factoring, we're actually selling those accounts receivable. And then there's, factoring with recourse and without recourse. We won't go into that depth. Other types of secured loans, inventory loans, a blanket inventory lien, okay? And so, it's not over the accounts receivable, this is over the inventory that we're potentially purchasing. The trust receipt, buyer holds specific inventory in trust for the lender. So as soon as we sell that inventory, okay, and they talk about, auto dealership, so when we sell that particular car, we're going to pay off that loan that we used to buy that car. And field warehouse financing, right? You basically, everything that's in the warehouse, all right, is used as collateral, right? To secure, okay, those loans. With secured loans, okay, secured loans lead to lower interest because they're backed with something, right? Unsecured loans have higher interest. And so that's what we've basically done, right? We borrowed money. We ended up borrowing, okay, $60,000 because remember, we're going to run out of money. And so they're just showing you how this flows through. That we no longer breach, right, the compensating balance or the loan covenant. Right, we have positive cash across the board. This was accomplished most likely from the Treasury Department. If your organization is large enough, they're going to have their own Treasury Department. If not, it's probably the controller, right? And that table that we kind of blew past, right? It talks about that there. And that's the end of chapter 16. All right. So 17, for the most part, keeping with the kind of the same aspect of financing and borrowing money, we're going to look more long term, right, instead of short term. So that's the end for today. Let me go ahead and stop the recording. And oops. I hope you did well on your exam.